It's the largest bank meltdown since the Great Recession more than a decade ago. Silicon Valley Bank, a bank that caters largely to startups and venture capitalists in the tech world, collapsed this week, making it the second biggest bank failure in U.S. history. It's now under the control of the Federal Deposit Insurance Corporation, FDIC, which says depositors will be able to access their money by tomorrow. But Standard Insurance only protects up to $250,000 per depositor. Joining me now, California Congresswoman Katie Porter, member of the House Committee on Oversight and Reform. She's also recently announced she's running for Senate in California. Congresswoman Porter, thank you for coming to the Sunday Show.
Thank you for having me.
Okay, so the FDIC is briefing California lawmakers in just a few hours. What are you expecting to hear from them, and what information are you demanding to receive?
We actually were able to have our briefing last night. The FDIC was able to accommodate us, which we appreciated. And I want to emphasize to everybody how hard these really dedicated, often career, lifelong public servants are working to make sure that hopefully Silicon Valley Bank is able to open on Monday. That's the goal. If we're able to achieve that, I think that would be a terrific outcome here. Hopefully the bank will have a new buyer. That's usually the best case scenario in these kinds of situations. The bank typically closes on a Friday. They look for a buyer. A new buyer comes in, usually a bigger bank, opens it on Monday, and everyone's able to take back to business as normal. This is a little different in part because our banking laws were written in kind of an analog era in which nothing happened on the weekend. And now we're in an era with online banking, with Twitter, with investors here at the bank, depositors at the bank communicating, and that is making the sort of banking process continue to move and evolve over the weekend, which doesn't give the FDIC and federal regulators as much time to stabilize the bank and find a buyer because everything's moving underneath them this weekend.
Mm-hmm. In the Washington Post story about the closing of the bank, you expressed concern that if they can't process payroll, that we could see layoffs on Monday. Is that still a concern?
So California state law here is intersecting with federal banking law, which is creating this issue. California state law requires employers to make payroll, to pay people out for their past work within so many days. And that's going to fall on Monday for a lot of these employers. That's when they normally make payroll. So they're worried about if they aren't able to pay because their money is at Silicon Valley Bank and it remains closed, they could be liable under California law, including personally liable for the people on the boards of directors. So this is a good law aimed at curbing corporate abuse, at making sure workers are paid promptly for work they've performed. I've been in touch with the governor's office, and I believe they are working and I have some ideas about how they could prevent liability and hopefully prevent what are really needless layoffs and furloughs here. Because again, the underlying businesses are in great shape. They have their money at the bank, and the bank, by the way, has significant assets. The money isn't missing. We don't have any evidence that there's been any kind of theft or problem. The mismatch here is between the assets they have, which are long-term assets, securities that you often hold to maturity, and what's happening at the bank, which is people want their money back today. And so that's creating this mismatch. But Silicon Valley Bank has significant assets, and I think ultimately we'll be able to weather this and hopefully be sold.
So for a lot of people, this bank closing came from out of nowhere. So I'm wondering how much of a factor were rising interest rates in this shutdown?
So rising interest rates were really the factor that caused the bank to have this problem, along with, in some ways, the pandemic, and in some ways, the bank's own management strategy. What basically happened here is in late 2020, the bank began to grow rapidly. They took in lots and lots and lots of deposits, millions of dollars. And then they turn around, and how banks make money is they take our money, the deposits, and they go and invest them. And it's that return that generates their profit. And here, Silicon Valley Bank invested in things like U.S. treasuries. And at the time, interest rates were very low. And so these treasuries these bonds have a very low interest rate. And they're long term. You're supposed to hold them to maturity, like 10 years from now. In the meantime, the Fed has raised interest rates aggressively, really as quickly or more quickly than we've ever seen the Fed do it. And that created higher interest rates. And people were saying, we're going to move our money. We want our money somewhere else. And the bank had to keep raising interest rates to attract deposits. So we call this sometimes a net interest match, a net interest income problem. The good news is those underlying bonds that the bank bought are still valuable. They're U.S. treasuries. They're really the safest place the bank could have invested the money. But there are real questions about why the bank didn't anticipate one of the most fundamental financial facts that everybody should know, which is interest rates go up and they go down. You can't bet on them staying low forever. They didn't. They went up, and the bank wasn't prepared for it. And there are some real oversight questions about that.